Hello, good morning. It's Tuesday the 3rd. I'm FX Plume and this is the market brief, and we're back after another long weekend in the UK. I actually missed a memo about that one. I found out at 11 o'clock on Friday when I tried to book a meeting for Bank Holiday Monday. But never mind, onwards. We are indeed back at the coalface, and it looks pretty likely that the MPC will deliver another rate hike this week. That is despite warnings of the recession risk coming from the Institute of Directors. Their measure of economic confidence dropped from -4 to -36. And it's an interesting one to consider. Ahead of every single recession since the 1970s, there has been a fall in confidence and indeed in business investment as the directors switch from expansive to protective modes in their businesses. We've already seen the higher cost of living lead to lower consumer confidence, which has hit retail sales. So with all these recessionary concerns floating around, we may see Governor Bailey provide a little more clarity over the policy outlook. It would certainly be useful for the market to be provided with a little comfort if we knew where the MPC currently sees interest rates topping out, for example. But a word to the wise, any suggestion of a pause or break in the current rate hikes may trigger a sterling sell-off, because the Fed policy has very clearly outlined plans to hike between 0.75 and 1% in the next couple of months or so. Yeah, my dog is coming, it's okay. And yesterday we saw sterling fell to 124.90 against the dollar, and we remain below the 120 level against the euro. We open around 119.20 this morning. Over in the US, the Fed meeting will kick off today. The expected 50 basis point rate hike will be announced tomorrow. This has been the market expectation since Powell addressed the IMF annual meeting a couple of weeks ago. And indeed, the Fed focus has shifted from recovery and continued economic growth to now very much committing to dealing with inflation. In addition to the rate hike, they will tighten monetary policy further by beginning to reduce the Fed's balance sheet. That will see them sell off about $90 billion of assets each month, and that will have the effect of withdrawing liquidity from the economy. The dollar index has been setting new highs over the past few weeks, driven by this policy divergence between the US and other G7 economies. Indeed, the dollar index was further supported when Japan confirmed they would maintain their ultra-easy monetary policy. That saw the yen hit a 20-year low. The dollar index looks a little overbought at the moment now, though. Yesterday we topped out at 103.65, so we may very well see a correction after the rate decision by rumour, sell fact and all that. However, bear in mind it's non-farm Friday this week, and that may encourage the market to hold their dollar positions just a little longer. Not to suggest that we're more influential than the Fed, but if it is the sweepstake on Friday that triggers the short-term sell-off rather than Powell's press conference, I mean, questions have got to be asked, right? Ahead of all that fun, the forecasts are for a headline figure of about 400,000 new jobs this month. That'll be down just a little on the 431,000 new jobs reported in March. Have a think about that one. It's only a few days before Friday, when, of course, I'll be tapping you up for a bid in the sweepstake. Until then, have a great week, and do join me again tomorrow.
If you do not have a clue, then just tweet through and ask FX Blue.